Hello, and welcome back to Fidelity Focus. I'm Christopher Wong, Client Portfolio Strategist at Fidelity International. This month, we're opening with a topic close to every Singaporean's heart: food. The F&B sector is under pressure like never before. In August, we saw a record number of restaurant closures in nearly 2 decades. Once mighty names like Hai Di Lao have shut multiple outlets, even high-end venues are shutting its doors. Several Michelin-starred restaurants have closed over the last few months amidst rising costs and waning consumer spending. Yet amidst the turmoil, some players are thriving by reimagining the experience. Supermarkets like Don Don Donki are becoming dining destinations, offering casual, affordable options with food and drinks, attracting customers seeking alternatives to restaurants. These shifts in how and where we eat and drink point to deeper changes in consumer priorities. Now, what does that mean for Asia's economies, and more importantly, for investors? I'm joined by Stuart Rumble, Head of Investment Directing APAC at Fidelity International, who is in the Singapore office today from Hong Kong. Stuart, welcome.
Pleasure to be here, Chris.
So maybe, Stuart, the first thing we want to discuss today is about dining habits we discussed, right? So when dining habits change, sometimes can be a leading indicator of how consumers are spending and thinking about things. So are you seeing a similar trend in North Asia, in Hong Kong and in China?
Yeah, there's certainly some interesting trends going on in terms of consumption on the mainland and also in Hong Kong. And I think it's playing out somewhat in food and beverage, but it's also in other areas where we see things like toys, jewelry, also experiencing shifts. And I think there's a few things going on. I think consumers are definitely much more value conscious, and I think part of that is also in terms of the way that they spend their money, in terms of making sure they're doing proper research into products, ensuring they really understand the proposition of products, which provides opportunity and risk for companies. I think there's also an element of tapping into local heritage as well. So we see the rise of local brands. That's been a long-standing theme in food and beverage, but that's now translating out into other areas. And also the other area that's interesting is this sort of spending on emotional value items and experience-related spending. So there's a few things at play here.
So do you think people are just genuinely more value-orientated, or are they doing more emotional spending? And do you think this is linked to the pop mart craze we have seen in the last couple of months?
Yeah, really good question. I do think there is a genuine value element to it, a trade down, if you like, but it's more complex than that. I think that there's elements of an overhang of weak consumer sentiment from things like COVID. Obviously, it's been a relatively weak macro environment in China. Job security has been a concern among consumers. And so I think there is an emphasis on avoiding high ticket spending of the past and moving towards low ticket spending. But there's also other elements at play in terms of a sense of belonging and tapping into these emotional resonance of the characters or the goods that they're buying, the toys, if you like, and the heritage association as well. And perhaps also the fact that, it plays to a younger generation, a generation of local consumers that are perhaps more informed, pretty well off perhaps compared to their parents, maybe more international in their outlook as well. And, they get a lot of their information from social media, and I think a lot of the distribution channels and sales channels through social media is playing an effect here. And dare I say it, there's a little bit of a dopamine hit that comes with that. And we do see that also play out over history in difficult times. Somebody was saying to me just earlier that you had this lipstick craze around the financial crisis, for instance, where people would go out and buy lipstick for a little bit of a dopamine hit during difficult times. And a colleague was saying to me just the other day, they're doing the same thing with Labubus. They have a bad meeting at work, they go out and they buy a Labubu for a bit of a dopamine hit.
I think your colleague's not the only one. I have other friends who do the same.
Yeah.
A bad day, they go queue, pick up their Labubu, and they feel better right away.
The queues are longer than Chanel handbags now, right?
So.
I think that's the sign.
So it sounds like, Stuart, that the struggling F&B sector we opened this conversation with, and the blind box craze that you kind of alluded to as well, are two very distinct purchasing decisions, right? So if we were to translate and map this into investment ideas, what are our portfolio managers and this kind of seeing from this change in spending habits?
Yeah, a mix of opportunity and risks for sure. I think that not only has some of these popular products, toys, the Pop Mart name, obviously bubble tea, lapel gold as well in terms of jewelry. They've captured the imagination of consumers, but they've captured the imagination of investors as well. And we've seen some of the stocks of these companies perform exceptionally well. They've led the market, for around a year or so. And I think there's risks that come with that. They've done well, investors have benefited, and to an extent they've obviously been backed up by improving earnings as well, which is a good thing. But the sustainability of those earnings is the thing that you've got to look at closely. For instance, if we take some of the toy manufacturers, they have a growing addressable market by going global, but their success really relies on making sure they've got innovative IP, new characters coming that really resonate in the same way as they have done before. And that's a hard thing to get right consistently. The last thing as well is just simply valuations. How much do you pay for this future earnings growth? At the moment, some of the valuations here are looking very stretched versus other opportunities out there in the market. For us, I think there are trends within the consumer space that are perhaps more robust and available at a better valuation.
So you spoke about local brands. These products arguably have been around for a long time. So how are these local brands, local players competing with incumbents who tend to be foreign brands in China?
The knowledge of the local consumer base goes a long way, but it's how they get that information and those insights, because the international brands have been onshore and been in this part of the world for a long time too, and they've been successful. Yeah. But I think being able to adapt to a changing consumer and the speed of that adaptation is where the key lies. Maybe whether that's trends around particular products, whether it's price points, and being able to then turn around products, develop products, and turn that around and bring that to market at a speed that the global brands cannot do has been a real key to success to some of these consumer companies. It's a real edge.
And that's a good point, because even in Singapore, where we're based and filming today, the Chinese electric vehicle manufacturers have taken over the share of new sales of vehicles in Singapore, upseating some of the traditional Japanese automakers here. And what's been interesting is not only has the largest one been dominating, this has started to spread to some of the smaller players in the last couple of months and weeks of data of car sales.
It's a great example because for a couple of reasons. I think, obviously autos are a complex product with many parts, deep supply chains from all over the world. But the manufacturing processes for EVs have really developed at a rapid pace over the last several years. And the key thing is being able to develop vehicles, produce vehicles en masse with a lot of customization to local needs again. Mm-hmm. And I think that's what the Chinese EV players have really excelled at. But they've done that with maintaining a really high quality build as well. And the production efficiency at the same time means that the cost has been a lot lower. So it's very understandable when you're delivering a very relevant product to consumers with choices around what they want at a competitive price point quickly, that the Chinese EV brands are successful.
Yeah, I guess we can then conclude that really taste and choices of the consumer is changing. And also Chinese companies' innovation and their dynamism is at play.
But I do go back to my point around, success breeds competition as well. And there's no place more competitive than the Chinese consumer market. If you can survive there as a company, you can survive anywhere.
Some dismiss the recent recovery in Chinese equities as a dead cat bounce. Now, is that noise in your opinion, or is it start of something a little bit more sustainable?
The starting point for Chinese equities, in terms of valuations, was healthy relative to the region, relative to its own history, and also US equities, which has been in the the sort of spotlight for investors. So that's not a bad starting point in terms of valuation, but of course there were some risks around at the time, tariffs, worried about the outlook. We had policy support beginning in September last year, really, where it became clear that the government were really focused on addressing some of the challenges that were affecting Chinese growth, things like the property market, etc., weak consumption. And we've seen a lot of measures to try and help improve that. And then, of course, we also had a reminder of how innovative the Chinese companies can be in terms of DeepSeek, but we've also had some real innovation in biotech, and that's been a good performing part of the market. And the combination of these factors, I think, have really helped to boost investor sentiment. And we've seen flows come back into Chinese equities, which has helped them rally. A lot of that flow has been domestically led. It's definitely the case that international investors have probably been mostly on the sidelines. And their question now a lot is, okay, how sustainable is this? For me, I think for it to be more durable, it would be great to see earnings growth broaden out. It's been a mixed picture. In fact, it's been quite narrow in terms of earnings growth. Some sectors, some narrowly focused sectors like tech, for instance, has led the way. And for this to be sustainable, it would be great to see a little bit more broader earnings growth in the next 6 to 12 months. Another factor could be potentially increase in policy support from the government. We will soon get the 15th five-year plan from the government, so we look at that closely. We're not expecting any sort of big bang type stimulus still. It's going to be very sort of incremental and very targeted, but positive developments on that front will go further to improving sentiment.
So Stuart, it sounds like you are cautiously optimistic. So how are our portfolio managers kind of managing their Chinese equity investments at the moment?
Yeah, there's certainly plenty of opportunities under the surface, but I think you really need to be selective now. What that means, I think, is paying attention to where there is sustainable growth, maybe being skeptical of some of the hype, particularly when that comes with high valuations. And we mentioned some of those areas that may perform slightly less well than they have done in the past. Areas like EVs, maybe some of the hot areas of consumer and food and beverage, as you mentioned. And I think, when you look at perhaps a focus on quality and a focus on valuation, often that's associated with a slightly contrarian approach. That probably stands you in quite good stead for stepping into Chinese equities at the moment, because valuations still look appealing versus history. And a lot of traditional names that would often fall into the label of sort of growth or offering you a decent return on equity can actually be, thought of now as a slightly sort of contrarian or value type play. And then when you look at areas like industrials, again, usually a very mixed bag, but opportunities across a range of different areas, whether that's due to sector consolidation and things like policies such as anti-involution is accelerating that in some areas. Areas like batteries or the cement sector offer opportunities, again, good valuations. And then, just growing penetration in some areas, or growing overseas revenues in things like machine tools, in the industrial sector, logistics companies, car service companies. There's a few opportunities, but you have to be selective.
So I guess it's down again to the same things, fundamentals, valuations, and sometimes it can be rewarding to not lean with the crowd, but really just try to be ahead in areas that no one wants or are very likely positioned.
Yeah, and the great thing about this, this sort of contrarian approach is that ultimately what you're doing is it just ensures that you're buying at a lower entry point, and that in theory then improves the expected return over a period of time. And I think you need to be a long-term investor when it comes to this approach.
Yeah, it's akin to going to the department store and not buying when things are marked up. You want to buy it from the discount bin or when things are marked down. So Stuart, I think you agree with me that Asia is more than China, right? There are many diverse, broad opportunities out there. So what are some of the blind spots you think investors have when it comes to investing in Asia?
Yeah, I think rather than blind spots, I guess I characterize them as things that may be underappreciated, and there's a couple I would pick out. Investors get sort of swept up in just focusing on the large cap names. And I think what they miss is potentially looking beyond those areas and large caps into other parts of the area. It's a rich, diverse market across the breadth of Asia. And in fact, some of the most innovative companies lie in the small and mid cap area. And not only are they great at growing their revenues, they can be quite conservative in terms of cash flow and balance sheets. But a broad theme that we see that I think is also underappreciated is just the improvement in corporate governance. And there's been a huge shift in recent years. It began with Japan, and methods and initiatives introduced by the government for improving shareholder returns there. In China, we've seen payouts improve, that is increasing dividend yields and buybacks as well. And now more recently in Korea, we've had the Value Up program introduced by the government. Ultimately, it aims to close that discount that we're very familiar with Korean equities relative to the rest of the region, and it comes through things like increasing board diversity and giving a little bit more influence to minority shareholders. And alongside that, we hope that it translates into better return on equities and better payouts for shareholders. And there's plenty of scope for that to improve. I think on average, you're looking at a 25% payout ratio for Korean equities, whereas in Japan, it's probably 10 points higher than that, and in developed markets you're probably closer to like 40% payout ratio. So there's a real opportunity in Korea, China, Japan, and more broadly for improving shareholder returns through better corporate governance.
Sticking to the topic of changing perceptions, Asian equities are often seen as growth only. Well, admittedly, because economic growth has been stronger than developed markets for many years, there are still many trends underway, but is Asia all about growth investing? Are there options for maybe a bit more conservative equity investors to look at?
Yeah, I think so. I mean, traditional sectors, banks, insurance, property, they throw off, and they always have thrown off a reasonable amount of income and dividend yield. They're the sort of go-to places that I think a lot of Asian investors or investors in Asian equities are familiar with when they want to go for yield. But I think that also misses some of the improvement in dividend yields and payouts that we've seen in other areas. And I mentioned it's partly to do with corporate governance, but it's also been forged through what's been quite a difficult economic environment. And China is another good example of this, where companies have just had to be more efficient and conservative with their balance sheet, where they're generating free cash flow. Not only do they want to retain that for defensiveness, but they're also happy once those buffers build up to pay some of that out to shareholders. And they recognize the importance of that increasingly, the sort of support from shareholders, benefits from a consistent and growing payout. So some of the dividend yields now on the Chinese companies away from the traditional areas, I'm thinking about consumer companies, some of the industrial companies, for instance, you can be looking at a 4 to 5% dividend yield, which is, a nice thing to compound over time.
And that's a marked shift from the past where it's all about growth. Now it's offering value, it's offering attractive dividends relative to what you get on bonds in China, for example, right? While still participating in some of the structural growth trends we're seeing in China.
That's exactly right. And you're in an environment where, obviously for domestic investors, bond yields are very low. Policy support has come through monetary easing, which has pushed their bond yields very low in China, close to record low levels. So with the property market, which is also an often place where investors look to put their money, not looking very attractive, investors have turned to equities in order to grow their savings through a combination of income and growth.
Yeah, so we spoke quite a bit about dividend companies in China, and I guess by extension that links to some Hong Kong listed stocks as well. How about dividend companies in Southeast Asia? Are there any opportunities that we're spotting?
Yeah, again, I think traditional areas are the place to invest. I mean, there's some very common places in Singapore that still are a regular source of income, and I think they can be a real ballast for portfolios or core holding. But increasingly, in Southeast Asia, places like Indonesia as well, throwing off a bit of income. Korea I mentioned as well. I think that's an area where we're seeing increasing allocations because Value Up is starting to increase payouts. So I think going back to the original point that you made, Chris, is that there's just a rich opportunity set now for income investors across the region. So I think if you are interested in taking this type of approach to allocating towards Asia, there's probably never been a better time to do it.
Yeah, and I like to also say that many of these consistent dividend payers tend to be quality companies because you need to be managed well, you need to have a sustainable business that has its natural moats to enable you to grow earnings and dividend, which is a function of earnings, right? So you get a little bit of quality in this sense, and you get that consistent dividend growth. It's just putting the boots down, doing your homework, picking the right companies.
And when we're in a very uncertain global outlook at the moment in terms of growth, geopolitical risks around tariffs, shifting supply chains, volatility in the market is arguably going to remain quite elevated. So having a cushion through income makes a lot of sense.
So Stuart, before we let you go today, if you were to leave our audiences with a parting message when it comes to investing in Asia and in China, what would it be?
Yeah, I would say despite some really strong returns this year, there's still an opportunity that exists to earn some decent returns going forward as well. But I do think you have to become more selective. There's a lot of great growth stories that we can tap into within the region, consistent with what investors expect. But what they might not expect is there's also an opportunity to get a good level of income and a slightly more balanced approach to allocating to the region because of things like improving corporate governance and improving payouts. So dividend yields are healthy and growing. I do think when you're becoming more selective, some caution through taking a focus on your balance sheet quality or company quality, companies that have really sustainable competitive edges, not getting swept up in some of the hype where there's quite rich valuations. And alongside that, being very careful about how much you pay for those future earnings. I think that can provide you some element of conservatism in terms of the allocation, some caution if you like. And that's probably not a bad thing in a very uncertain macro environment.
Sounds good. Thank you, Stuart, for joining us this time, and we look forward to welcoming you again.
Thanks, Chris.
Thank you.